Greetings, members, one and all of the Salivation Nation. Without these two big banks, gold and silver would be much, much higher. Let's explore. That's a pretty strong statement from somebody who doesn't really believe in a cabal in order to suppress the price of gold and silver. But nonetheless, what was shared with me by Mississippi Sun was really eye-opening if we follow the data back. And I think that the Office of the Comptroller should be trustworthy. But then again, as is always the case, you either have to trust the data sources or not. But with regardless, typically we tend to believe that which follows our confirmation bias. And so with that being said, I want to approach this story somewhat cautiously. It's a pretty strong title, but I do believe in the derivative markets are what is helping keeping prices down just by the very nature of what they are. Notwithstanding, natural market forces play a huge role in determining price action. But if we take away the derivatives, I believe that gold and silver would be much higher just for the very fact that they represent a much greater amount of entities than there actually are. So this is from this report. JP Morgan Chase and Citibank hold 90% of all gold and other precious metal derivatives held by all U.S. banks. Let that sink in for a moment. These two institutions alone make up 90% of all the precious metal derivatives in the United States. And there is a chart, and I would show you a screenshot of this story here from WallStreetOnParade.com, but their graphics are really blurry, and it really doesn't tell us a whole lot here. It's just that it has a little chart here that shows where precious metals under 1 year and precious metals between 1 and 5 years. Really don't understand it, but nonetheless, last Tuesday, the Office of the Comptroller released its quarterly report on derivatives held at the mega banks on Wall Street. Through the standard graphs that are included in the quarterly report, one graph jumped out. It showed a measured growth in precious metal derivatives at insured U.S. commercial banks and savings associations over the past 2 decades, and then an explosion in growth between the last quarter of 2021 and the end of the first quarter this year. And that is what the chart is, but it's very blurry. They should have had a better screenshot of that. But in just 1 quarter, precious metal derivatives had soared from $79.28 billion to $491.87 billion. That's a 520% increase in the span of 3 months. And that tells us something here, folks. And wow, it's crazy. It's crazy. They also have another graph that kind of shows a link to the whole report there. But nonetheless, having studied these quarterly reports since the 2008 financial crash, the folks at Wall Street on Parade knew where to head next. We went to the graphs in the OCC report showing the breakdown of different categories of derivatives at specific banks. And there's showing the precious metals contracts JP Morgan Chase had spiked to $330.123 billion as of March 31st, 2022. The same table showed that Citigroup's insured commercial bank Citibank held $144.148 billion in precious metals derivatives. According to the Federal Deposit Insurance Corporations, that's the FDIC, as of March 31st, 2022, there were 4,796 federally insured banks and savings associated in the U.S. Combine that figure with the latest report from the OCC, and it means that just 2 banks, JP Morgan Chase and Citibank, control 90% of the precious metal derivatives of all 4,796 insured financial institutions in the United States. That is mind-blowing. And I guess it's legal, or they've gotten away with it through some loophole or what have you. And they checked their previous OCC report, in the quarter ending December 31st, 2021, it showed that at the year end, JP Morgan Chase had reported only $28.182 billion in precious metal derivatives versus $330.123 billion 3/4 months later, a staggering increase of 1,071%, which means that perhaps some of the research done by some of you folks who have shared with me in the comment section that I've kind of blown off because it came from Lynette saying there was like 6,000 contracts to 1 ounce of physical silver. That very well may be true nowadays, given this report here. There's a footnote that attempted to explain the bizarre picture of what's going on in the gold market specifically. Beginning January 1 of 2022, the largest banks are required to calculate their derivative exposure amount for regulatory capital purposes using the standardized approach for counterparty credit risk. Under the CACCR, gold derivatives are considered precious metal derivatives contracts rather than exchange rate derivatives contract, resulting in an increase in reported precious metal derivatives contracts compared to prior quarters. The footnote raised more questions than it answered. I would say that's a head scratcher. According to legal definitions available at Cornell Law School, not to mention common sense, an exchange rate derivative contract is a cross-currency interest rate swap, forward foreign exchange contract, currency option purchased, or any other instrument linked to to exchange rates that gives rise to similar counterparty risk. Why would a gold derivatives contract have ever been classified as an exchange rate contract? Gold contracts are to foreign exchange contracts what zebras are to centipede. There is the decided perception that Wall Street megabanks have been hiding from the public the true extent of the involvement of the gold market through some ginned-up derivatives definition. In addition to the wild growth in precious metal exposures, JP Morgan Chase Citibank's precious metal holdings in 1 quarter had grown from $6.979 billion to $114.148 billion. But Bank of America, a peer bank to JP Morgan Chase and Citibank, showed no such gargantuan increase in the precious metals holdings from year-end 2021 to March 31st, 2022. The OCC report that Bank of America held $27.32 billion in precious metal contracts on December 31st, 2021 versus $29.441 billion on March 31st of 2022, an increase of just 7.76%. Still a pretty big increase if you ask me. To me, these derivatives are much more of a turnoff. These ETFs and the like are much more of a turnoff than ever before. I used to kind of, sympathize with those who got into those markets. But I think this story, if true, is leaning much more against supporting such measures. Even given that there's very low premiums, you are in a position where you essentially have something that's backed by nothing. It's basically like getting a crypto. You're exposed to the simple price, a fake price, really, when you think about it, compared to the physical metal. Even what you're selling it for is more than the spot price these days, except for now that premiums are going down, you're seeing a lot of the privately issued silver being sold for right at spot again. Same thing with gold. JP Morgan Chase is the last bank in the U.S. that should have a $333 billion involvement in precious metals, especially after this. They have been charged with criminal felony of precious metals manipulation, rigging, RICO statute. You've heard me talk about that even just recently. I posted a video talking about a trial for 3 or 4 of those who were involved in it with this precious metals manipulation that is going on. This is not a good look. And with this newest information here that we're getting about this massive expansion in derivatives here, without these 2 banks, and this gold and silver, I believe, would be higher than they are now, considerably. Because you think about it, the conditions that we're seeing now, Many people feel that with inflation and with recession happening now, though history is a guide, and usually during the beginnings of such problems and issues, it takes a little while, but usually by about this time we should see prices going up instead of down. And they are staying down and going down even further. It kind of just makes you wonder what's going on here. Now, I don't know. I'm asking the question. I'm not theorizing. But with this massive derivative market, and really with a poor explanation with the footnotes there, it leads you to wonder. A fascinating report indeed, and thanks to Mississippi Sun for sending this along to me. And this is something that actually, since I'm not referencing the report, I'm going to post a link to this in the description of the video below, because I didn't read it all, I didn't go through all the details of it. And there is some related articles along with it too that you can check out to see what's going on with this, and follow further links to take a deeper dive into this. Fascinating indeed. But anyways, I will look at this last paragraph here because I think this is quite telling. The ongoing hearings of the January 6th House Select Committee are peeling back the layers of corruption in the highest office in the United States during the Trump administration. Maybe it's time for another House Select Committee to conduct an equally broad investigation of Wall Street's mega banks before they crashed the U.S. economy in a replay of 2008. Clearly, Wall Street's federal regulators have failed in their jobs just as miserably as the White House counsel and White House chief of staff failed in their jobs in the Trump administration. So, I don't know. To me, this paragraph is coming to us from people who believe that the Trump administration did some wrongdoing during that January 6th thing. Bob, I don't agree with that, but this should give you an idea of where this is coming from somebody who's not a Trump fan. So there you go. So very interesting indeed. We'll see how it plays out. Let me know what your thoughts are in the comment section below. I would like to extend a multitude of gratitude to you all for taking the time to watch, and to encourage you to please rate, share, and to actually stack physical gold and physical silver. Yes, indeed. Go ahead and stack the physical stuff. To me, it's worth the premiums considering what's happening. I would advise, just as a matter of principle, to stay away from ETFs. That's what I'm advising at this point. I'm not a financial advisor. Do your own due diligence for sure. But as far as physical paper contracts or paper representations of the physical, the only one I would think about is maybe Sprott, because they're actually backed by the physical. Other than that, I'd stay away from them. A multitude of gratitude again to you all. By the way, press that notification bell. Press the thumbs up button. It does help the algorithm. Trying to get my videos out to more people, to a wider audience. So if you do that, it really does help. And even putting a little comment in there, even if it's algorithm food, I'll take it all. A multitude of gratitude to you all again.